Hi everyone, it's Stephen from Cheltenham Tax Accountants. I'm just starting to do a few quick, simple, fairly informal videos. It will be part of our weekly or monthly newsletter. I've supposedly had a monthly newsletter for a few years now, but we tend to send it out every few months. So rather than holding out for lots of things to share with you, when we get ideas, experiences from other clients, we've had some issues or there's some important news, I thought we'd do something a bit more regular, a bit more informal, to keep you guys updated with everything. So you'll see we're on our Facebook page here. So I think we can just start off. I just want to point out we have got a Facebook page, as you know, a lot of businesses have nowadays. If you can find the time to please find us on Facebook and like the page, that'd be fantastic. Just build a bit of better profile locally on Facebook. We've got quite a good Google presence anyway, which is great. But the main reason why I wanted to show you to this page, take you here, is we have a group I've just created, and it's just for Cheltenham Tax Accountants clients. So if you can find the business page on Facebook and then go on to groups, and you can send an invite to join the group, and I can add you to the list. There's currently around 25. I want to build that up. I want to get a little bit of a community going so we can maybe start sharing some ideas and finding other ways, if possible, to add a bit more value to our clients. And we'll see how it goes. You know, if it's not something that works, then no one loses out. But hopefully it can, lead on to other things. So as I said, it's going to be a nice, short, sweet video, fairly informal. As you can see, I'm not dressed for the office today. So the main idea I had with this video was a client came in recently. He might be seeing this. I won't mention his name. He came in recently and he asked a question about cashing in a pension. So he's had multiple pensions, and on this occasion he had two pensions, and they both had different amounts in the pots, and he was entitled to take them out, and the pension company gave him a calculation saying this is the tax we're going to stop at source. So they give you basically like a pay slip to say this is what we're going to stop you, which is often 20% or 40% tax. So this is the projection what you end up with in your pocket, in your bank account. So the question he asked me was, A, is this tax right? Does this look like the right amount of tax I should be paying? And B, is there any benefit in spreading these pensions? Do I get penalised for taking them both out at the same time? Both, really, really good questions, and we do get asked these from time to time. And because it's relevant to a lot of people that sort of age are considering taking out something from their pension, I thought I'd share it with everybody. So you can take out 20. Just to give you a bit of background, obviously, as accountants, we can't give you any financial advice, but we can give you a bit of an idea in the tax implications of drawing from your pension or putting into your pension. So most people are aware that you can take out 25% of your pension tax-free, and anything you take out of the pot after that is taxable. And it essentially gets taxed at what's called your marginal rate. So if you've got other income, it gets added on as another slice to that income. And if you happen to be a 40% taxpayer, you'll pay 40% tax. Hey everyone, it's me again. You might notice I've changed my clothes. I had to end the previous video, so thought I'd just pick up where I left off, which was talking about the pensions. So the client came to see me. He had multiple pension pots available to take out, and the question was, is there any tax efficiency in either taking them out at the same time or not taking them out at the same time? So what happens when you cash in or you draw a lump sum out of your pension is you get 25% tax free usually, and normally the rest of it is taxed at your marginal rate. So your marginal rate is basically whatever tax rate you pay tax at. So if someone, for example, earns, let's say 15k a year from a rental property, and that they want to cash in their pensions, you can earn £43,000 before you get into high rate tax. So they've essentially got £28,000 remaining up to 43k. So the first 28k of the lump sum in pensions will be taxed at 20% tax, because that keeps them under the 43k limit in total. Anything that takes them above 43k will be taxed at 40% tax. And if you were more than, I think it's around £150,000, it's 45% tax. So you want to reduce the rate you're paying tax. So it depends on the size of the pot, the size of the numbers. In this particular one in question, the two pots, individually, they were below the 43k limit. And adding on to the client's other income, he had the opportunity that if he took one of the pensions out this tax year, so before the 5th of April 2018, he was still below £43,000. So that means ultimately when we do his tax return, he won't pay 40% tax, only pay 20% tax. And then he could take the other pension after the 5th of April. So we're actually only talking a month or so difference. We could take one before the 5th of April, one after the 5th of April, and it's saving him essentially 20% tax for part of that amount of income. And in this case, it was thousands of pounds just by simply contacting the pension provider and saying, can I cash in one before the 5th of April and one after the 5th of April? Sounds like really basic, simple advice, but I have seen cases where people don't give it any sort of thought and they take it all out straight away. And if you need the money, fantastic. You need the money straight away. That you've earmarked it for something, that's not a problem. But if you don't need the money, then it makes sense to spread it over multiple tax years. And I've seen some people, they've lost out because they didn't look at that at the beginning. So if anyone's at that sort of age where you've got the opportunity to take out lump sums in your pension, it's just something to consider. Could save you a few £1,000s without really doing anything. What happens when you do take the pension out is they tax it similar to employment income. So you get a P45, so this is the amount of tax we've stopped you. That can often be too much tax, but sometimes not enough tax, but usually they either stop you 20% or 40% tax. And you keep that P45, we add it onto your personal tax return at the end of the year. All gets added together, we work out what the tax should be and give you credit for anything you've already paid. But as I said, if you can try and spread it over the two tax years, you can't lose. You can only gain, essentially. So I hope that's been quite helpful, and I'll put something else together for the next couple of weeks. So touch base with you then. Thanks.